In this video, I'm going to discuss 3 sectors or industries that I try to avoid at all costs, and this is for very good reasons, but there's one reason that actually is pretty common with all those industries that I don't invest into, and this is basically that I'm not really, kind of good in them. I don't really understand them. And this is something that Warren Buffett talks about, and he talks about the circle of competence, that you should actually invest in industries that you know, not in industries that you think you know. Sometimes you come up in some stocks that you believe that you know something about them, but you invest in them just because the PE looks good or because the metrics look good. And in my personal experience, this is when you could potentially fall in a value trap, because you're buying it not because you understand it, not because you understand why the market is mispricing it, but you're basically buying because it looks cheap. And this is normally when the cheap keeps getting cheaper, because you don't understand the industry enough to be able to tell why it's undervalued or if it's actually a value trap or not. And this is something that I really implement in my strategy, Warren Buffett's circle of competence. I have my own circle of competence and I stick to it. There's a lot of different reasons around those specific industries why I don't invest in them, and this is what I'm going to talk about in this video. But the main reason I implement the circle of competence is because I am more of a concentrated investor. I don't diversify. Sometimes I own 6 or 7 stocks, sometimes 10 stocks, not more than 12 stocks. 12 stocks is pretty much my maximum. So I don't really like to diversify. Therefore, I cannot own 30 or 35 stocks to spread my risks around industries that I don't know, which is why my case might be different from your case. For example, if you don't understand NVIDIA and you have 1% of your portfolio in NVIDIA, then you're different from me personally, because sometimes I put in 10 to 15% in my portfolio in one specific stock. Now, the first industry that I try to avoid at all costs, and this is actually banks, and it might surprise a lot of you, and you might tell me, why don't you invest in banks? How come you can't, you don't buy a JP Morgan, or you don't buy Bank of America or Wells Fargo or Citigroup and all these kind of banks? Well, I actually don't invest in them, and this chart speaks for itself. Bank of America is still trading at the same price it was trading at in 1997, even lower than what it was before the 2008 financial crisis. Now, the main reason for that is banks, they don't actually have the business model that's going to give you high returns for the very long term. They cannot take the free cash flow and grow organically and reinvest it to try to create more value. They mostly return value to shareholders through buybacks and dividends. But the beauty about long-term compounding are companies like Meta, like Apple and Amazon. They can take the free cash flow, reinvest it, start new businesses, acquire other companies. So there's no way pretty much for those banks to grow free cash flow per share, to have high return on invested capital, and be able to provide the long-term compounding that these other companies can actually provide, which is why I believe banks are not the best long-term investment. And even if you look at JPM, which is pretty much the best bank ever in the United States, you look at JPM, it has been performing well since 2008. It was sitting at around $50 per share, and now sitting at $150. But even if you bought any kind of other stock, maybe, Apple in 2008, you pretty much outperformed the best performing stock in the banks, which is actually JP Morgan, which really shows you that the banks are not the best long-term investments. And this is something else that I want to talk about with the banks, and it's mainly the small banks, which many of you buy them because they look cheap. But this is an example with the big banks, and I like to value the big banks on price to tangible book value per share. This is how you normally value them. Now, this is the difference between all those three. JPM in the green is actually trading at 1.95 tangible book, around 2 times tangible book value per share. Bank of America is trading at 1.28 times tangible book value per share, much lower than JPM, and Citigroup is trading at 54 cents on the dollar. 54 cents on the dollar for Citigroup. This is a massive difference between all those 3 banks. Yes, I'm sure it could be because of the management, or it could be because of how the bank is operating and growing, but it has to be with something that's on their book, something inside of their book, maybe something that's risky, some kind of risky assets. And in my experience, there's no way to really dig deep into their book and actually know what these banks are actually holding. And we don't know that. We don't know why Citigroup is trading at 54 cents on the dollar. dollar. We don't have an edge above the market. Maybe the market is mispricing it, but maybe the market knows something we don't know about what Citigroup actually has on their books, and it could be something explosive like what the banks had in 2008 or 2009. But unless you go and you read, I don't know, thousands and thousands of pages around those things, I believe you will never be able to tell with any kind of certainty what kind of assets they have on book. Yes, you might be able to read some highlights of the balance sheet, on YouTube. A lot of people, whenever we had the SVB, everyone became a banking expert. I believe it's much harder than that, and it's very hard to dig really deep within their book to see what they actually have. So I don't see how we can have some kind of an edge with the banks. But I believe a lot of people also make a mistake and they invest in foreign small cap growth banks, like some bank in India or a lot of the banks in South America. I believe a bank called STNE and another one, New Bank or something like that. People ask me about them. But a lot of people buy them just because the P is cheap or because the metrics look good. But they don't understand the regulations in Brazil. They don't understand what they might have on their book in Brazil. Any kind of bad thing on their book or any change in regulation, it could cause the stock to go down 50% tomorrow. So I truly believe people don't really know the risks whenever they're actually investing in the banks. Now, if you run a 35 or 40 stock portfolio and you own 3 or 5 banks, then you're diversified. But I'm saying if you're more of a concentrated investor like myself, there's no edge for me to make money in banks. So I don't invest in banks. All right. Now, the second one that I try to avoid pretty much at all costs, and I do my best to avoid it, although I do break this rule sometimes, and those are small cap pharmas and bio stocks. Now, the biotechnology stocks, I can answer it very quickly, and this is because I know nothing about biotechnology, although there have been some amazing performers in this industry. But I'm not going to try to pretend, but I just don't know anything around it, so I just leave it alone. But with the small cap pharmas and even the larger cap pharmas, even Pfizer and Johnson & Johnson, all those things, the biggest risk with pharmaceutical is pretty much them having some kind of a litigation lawsuit or accusation or some kind of a lawsuit or whatever you really want to call them. But we can see what happened with 3M, with the earplugs lawsuit for the healthcare division of 3M. It's going to cost them maybe up to $85 billion. A lot of dividend investors were long 3M. It was pretty much the best stock ever. How could you say something bad about 3M a few years ago? But then they had this litigation lawsuit and it changed the entire company. We can see what's happening with Johnson & Johnson. This is a blue chip company. They're also facing a lawsuit and they're spinning off some kind of healthcare business and some kind of other business, and they're going to face a lot of debt. So you could do the best valuation model in the world on something like Pfizer or Johnson & Johnson. Let's say you do it on Friday, and then the weekend goes by and you wake up Monday and they have some kind of lawsuit around some certain drug and the stock goes down 20 to 30% and your entire valuation model gets messed up. Now, this is, the biggest risk, that you could do the best research possible, the best valuation model possible. But whenever these lawsuits, they come with those healthcare stocks, they come very hard, they're very expensive, they're very hard to fight because they're messing with people's health, which is something that's very, very bad. But this is something that's pretty much unexpected. You cannot predict those things. You cannot expect those things. So I try my best to avoid them. Now, sometimes I do invest in them if they're, I find them cheap enough. Something like CVS, although CVS did face an opioid lawsuit, but I believe they paid it off, last year, and, it's also a risk. But I believe CVS a little bit more diversified. Even Pfizer is actually not bad at those prices. But if Pfizer or CVS or some kind of a pharmaceutical stock gets some kind of lawsuit tomorrow, the stock is going to go down a lot, the balance sheet is going to get messed up, and it's just an unexpected risk. So I do my best to try to avoid them as much as possible unless I find a very good deal with them in the markets. Now, the last one, which might surprise a lot of you, are actually semi stocks. And you might say, how come you don't invest in semi? You missed on Nvidia, you missed on AMD, you missed on all these kind of semi stocks. And I personally did miss on them, but I have a lot of other stocks that do well. I have, for example, a small cap food company that's up more than 100% in pretty much 2 or 3 months, actually a micro cap company. And I have a lot of other gold miners that are up 50 or 60%. And I have other retail stocks that are doing very well. So I try to stick with industries I understand. I don't believe I'm knowledgeable enough to buy, for example, Nvidia and for me to be able to tell the supply demand dynamics of those chips, how the price is going to be affected with the supply demand, which kind of company has the best chip, what is the competitive advantage of Nvidia versus Micron versus AMD and all these kind of companies. This is not something that I can deeply understand for me to put in 10% of my portfolio in a specific chip company. And most of them, not all of them, but most of them are pretty capital heavy kind of businesses, and I try to avoid these kind of companies. So yeah, I'm just stick with companies that actually understand and industries that I understand. I believe what Warren Buffett said is right, that you don't have to understand everything to be able to make money in the hottest thing in the market, and the best one is actually to specialize within certain industries where you actually become an expert and you really know if the company is mispricing something or if the company is actually some kind of a value trap. But those are three sectors and industries that I try to avoid at all costs. Thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.